Okay, you're the brave ones who came in nice and early in the morning to hit the day running. So we'll just start, and people will join in later when they can. So I'd just like to thank my panelists for preparing for this session. I'll introduce myself first. So my name is Sunil. I'm really an entrepreneur for the last 15 years. I set up a research services company in India, in Cambridge, UK. I'm based in Cambridge in the UK. And we built that and sold that to Piramal in 2011. And after that, we started investing our own money. That's more like business angels or a family office, whilst we built capabilities to support a lot of the startups that we invested into. So we've built a 200-person research service company again in India. We have an incubator site in Cambridge in the UK, and we're raising a further seed fund to support our angel investments that we're doing right now. So we could talk more about that later, but the other panelists to maybe give a couple of lines introducing themselves and what their fund does. Atul, you go first.
Sure. Good morning, I'm Atul Varadachari, and I'm with a group called Fanon Innovation Studio. We're based in Houston, and we are as early in seed as you can get because we actually, in most cases, we co-found the companies in partnership, in many cases with academic founders or sometimes with entrepreneurs. And we do, about half of our technologies are in the therapeutics, pharma, and about half are medical devices or diagnostics.
Hi, I'm Chris Hansen, and I run a fund called Grant Park Ventures. And so I'm an engineer by training, so I started a bunch of different medical device companies. So that's actually the main thing I'm always working on, is trying to incubate companies. But we also have our VC firm that will do healthcare IT and ed tech investments. So anywhere from like $250 to $1 million check size we'll do. We're technically actually not even considered a fund, so we do SPVs, which are single purpose vehicles into a startup. And so we have our LP base that we kind of lean on for that to fund those endeavors that we choose to do.
Good morning. My name is Mackenzie Lowry. I am based in Boston. I'm with a venture fund called Rock Health. Rock Health is both an early seed stage venture fund based in San Francisco and a research organization. I'm boots on the ground on the East Coast, so I work with a lot of entrepreneurs in Boston and New York City.
Good morning, my name is Mike Wiley. I work for the New Jersey Health Foundation and its affiliate venture fund, Foundation Venture Capital Group. And we invest across a couple of different financing products, if you will. At the earliest stage, we have a research and development grant program. We then step up to an innovation grant program where we support early stage commercialization. And then through the seed fund, we make small seed investments up to $500,000. We focus on a select group of affiliate partners. They're basically the research universities in New Jersey. So that's Princeton, Rutgers, Stevens Institute of Technology, NJIT, Rowan, and one non-university, the Kessler Institute, which is the number 2, I think, rehab hospital in the United States. So I think we'll get into it.
Great, thank you. So my next question is really to understand what's in your sweet spot of investing in terms of the tech. I mean, life science is very broad, healthcare IT or biotech. But what if it comes on your desk, what would be the one or two things you think, yeah, we really that's right in what we're looking to do right now? So I'll start at the other end this time. So Mike, you go first, because your room is a little bit broader, I imagine. So, but what is really in your sweet spot? Is it just anything from the university's vanilla that might make money?
So I always look for kind of a tighter aperture but my management team says good deals, we'll find a way here. But realistically, it's health. If you look at the portfolio, it's heavily dominated, I think, by therapeutics and kind of traditional medical devices. We're happy to take really kind of high-risk bets. We feel like from a nonprofit perspective, that's our mission. We're trying to fulfill our nonprofit mission. And so it really is across the healthcare spectrum, but I would say, digital health, medical device, therapeutics, but we're getting into agricultural-based, nutraceuticals. It kind of reflects, I think, the research base that we operate within New Jersey. but we're not limiting it. But if you look at the portfolio again, we'll take therapeutics, med device, digital health, and then we kind of branch out from there.
I guess a follow-on question from that would be, the pharma industry has been very dominant in New Jersey for such a long time. A lot of it has shifted further east, I hear. How's that affecting your ability to invest, finding the right talent, and supportive infrastructure around the investments that you make?
Yeah, that's a great question, actually. I think from a talent perspective, there actually is a tremendous amount of talent that we're trying to, be more efficient about leveraging, but we see a lot of those folks coming in as entrepreneurs now, who have spent maybe 25 years or so in big pharma and now funding biotechs. And as it relates to infrastructure, we are starting to see, so Biolabs, which is coming out of Boston, is now located in Princeton, actually just down the street from my office. Celgene just launched their own incubator in New Jersey. So like many other geographies, people have a kind of a plan on how to pull that infrastructure, which is so critical, obviously, in the life sciences space to have that infrastructure to support the entrepreneurs.
And the last question for you before we move on is, what kind of check size do you look at, and do you just literally follow other people's when they lead, or do you actually lead investments?
Yeah, we typically are the lead. We are very early, like in the laboratory early. Because we started with the research and development grant program, so we can see things at the basic science level, and then we go up from there. In terms of the seed fund, we invest up to $500,000 initially, but again, we're typically the lead. And I know we're going to get into other things on how we support post-financing.
Thank you for that. Mackenzie, now it's your turn to get grilled.
Yeah, of course.
So what's the focus? What's your sweet spot?
Yeah, so Rock Health started in Boston actually as the first venture fund dedicated to digital health. So our sweet spot, we like to say we optimize for impact. However, we really focus on the digital health category within tech-enabled healthcare. So not so much biotech or medical devices, and very much things that seem to be platform-oriented. So you can look at some of our sort of marquee investments like Collective Health in the insurance world, or Honor Health in the home care space. And so we optimize for impact in the digital health space in particular.
So Mackenzie, what do you really mean by digital health? It's a very broad term. It gets bandied around a lot. I see it in everybody's investments, like we do digital health. When you actually drill into them and they haven't done one, or they find it very difficult to find, let's say, digital health. But what does it mean for your fund, and what are you really looking for?
Yeah, that's a great question, and definitely, we all see the phrase digital health constantly. For us, we really define it broadly because it is a broad category, and there are a lot of great companies and great ideas under that large umbrella. So we simply say it's at the intersection of technology and healthcare, and then for each particular fund or investor, that can be a different focus depending on their experience. For us, it really comes back to that idea of optimizing for impact, so something that is not only a great business, but also scales well and can make a seismic change in the industry. So we actually have a pretty broad and varied portfolio within a pretty broad and varied category. So
it's anything like anything that might digitize something that's being done very traditionally, then becomes more efficient. Is anything in healthcare that might do that? Is that?
Yeah, I think that would be the classification for sure. And then as far as at least what I am commonly seeing in our portfolio and with companies that we meet, it's sort of almost defined by what it's not in some ways, where it's at least in terms of scalable software, I see that less so in the biotech category and less so in the medical device category, even if it's a part of one of those companies, and more so in solutions that upgrade and make an existing system more efficient in the healthcare world.
And how much do you generally invest? What are you looking to? What's the sweet spot?
We generally, we're pretty early, so we'll be in that first round, so a seed round or occasionally a Series A, so very early, generally small.
And in the geographic remit, we know that Mike's got much more of a sort of East Coast remit, but...
Yeah, we're not geographically focused, except for we look at US-based deals.
That's geographically focused.
Well, the US is huge, yeah.
Okay, Chris.
Yeah, so we do a lot of similar deals to Mackenzie, and kind of what I consider healthcare IT, like you were saying, digital health, what's that really mean? What's healthcare IT? So a lot of like AI, different platforms that are looking at, freeing up resources. Like we did this one deal, it's called Memorial Health. It's like a patient adherence platform using AI. We did another one that's kind of looking at streamlining, waiting times to surgery efficiencies, like in the hospital, and trying to, like if you take like an OR, you're like basically scrubbing, you're doing all these different things. So anything that's like cutting out time and adding more, say, patients or opportunities for the hospital to make money. And then traditionally, med tech, my background is from the cardiovascular side, so I tend to just understand that, but I wouldn't be, shy away from other areas within like a traditional maybe hardware space. But we're really looking at a lot of those companies now are kind of implementing different data solutions in terms of how they're either generating diagnostics or other information as well. So those are kind of two areas. We actually do some tech deals as well, but really healthcare is our main focus.
Are you technologists who wanted to then get into healthcare? Are you healthcare guys who said, actually, we can apply technology?
Yeah, so we're healthcare guys, and my partner happened to he was working at First Round Capital, started a company called Parsable that's not in healthcare at all, but he was actually in med school. So he was always he had this tech background, I had this healthcare background, we kind of merged it together. So, but healthcare is like where we primarily want to stick in right now.
Yeah. And again, how much do you invest in? Do you have a geographic remit?
Yeah, so US-based companies, 250,000 to, we could go upwards of $1 million. And then you kind of mentioned this earlier, I forgot to respond. We do like to do follow-on investments as well. And typically, maybe one round.
Preempting my next questions.
Sorry, yeah.
Carry on.
And, so check size-wise, 250 to $1 million. And then I have this kind of other element where I have actually a medtech incubator, and so that's kind of a different one where if I accepted a company within my incubator to use our resources, that's a whole other discussion. But in terms of straight VC, that's what we typically do.
Okay, thank you. Go Atul.
Sure.
Sweet spot.
Sweet spot is, I was asked that question yesterday, and my response was anything but immuno-oncology. And that's actually not far off. I think we do, we've been around for about a decade, and we started off doing a lot of medical device work. Really in the last 5 years, we've been doing almost entirely biotech pharma. But very broadly within that, the heavy focus on areas which are not hot. But actually just about a month ago, we hired a new very senior experienced medical device person as one of our managing directors. And so medical devices will start becoming important for us again. And I think in contradiction to what Mike said, I think, I'm in Houston, so again, I'm preempting your question, but we are focused on Houston. And one of our challenges in Houston is we don't have, like New Jersey or many other places, we actually don't have a lot of entrepreneurs, experienced life sciences entrepreneurs. So a critical part of the Fannin model is that we play a very important role as being part of the team, if you will. And so we are investors, but also part of the team. And that's why, as I mentioned before, in most cases, we actually co-found the companies with, in some cases, directly with the inventors, in other cases, with the entrepreneurs.
And your sweet spot in terms of what technologies or therapeutics or, you said anything but IO, but is it in medtech or is it where do you home in and what stage?
So really for the last 5 years, it's been almost entirely pharma. And so what we're looking for is novel sciences, typically new targets, new pathways, which have an asset associated with it. And so it's really early stage in the sense that in some cases we've gone in with just been a target and developed kind of a lead molecule. In others, there'll already be a molecule and an asset that we will develop. On the medical device side, again, we'll probably come in once a prototype is in place.
Okay. And you mentioned check size, right?
Well, so we support in combination of cash and kind. So typically we'll put in a couple of $100,000 in cash. That's primarily to pay for third-party costs like IP and prototyping, and we'll really budget about $1 million in total over the first couple of years.
Thank you. So in terms of O2H, we're therapeutics focused. So we really look at, in O2H as a company, we look for great science and in the therapeutic space, and strictly in the therapeutic space. And we see ourselves as enablers of that great science. And most early stage investing in this space, they need more than just money. So we've built this kind of ecosystem around supporting the startups, mainly in the UK, but we have done things outside of the UK as well, in Europe and the US. And what we're looking for is really, our sweet spot would be a really well-validated, a good target with limited chemical matter, and then we can come in and we would fund hit to lead or lead optimization program. That would be very much in our sweet spot. We're a therapeutic agnostic. We could invest, we can support as well through our research services group, which is in India. So we have plug-in capability in India to really drive that early stage of the program forward more quickly. We have some biology infrastructure and an incubator space in Cambridge in the UK. So O2H all is it's more than just the money. We've been investing from our own pockets for the last 4 or 5 years really, and now we're raising a larger seed fund to be able to do more of the same essentially. And our ticket sizes right now, we've done up to about $250K into a company, and that will expand to around $2 million into a company over the next 12 months. I think I've answered all my questions. So it kind of leads into my next question, which is that O2H enables, we can provide a lot of support. It's not just the money. At an early stage, generally it's more the money that is required, and there's a lot of time, effort, industry collaborations, science, and whatever you need. We hope that we can help plug those gaps, and that's what we spend a lot of our time doing. So I'm going to throw the question out to the rest of the panelists in terms of what can you provide to the entrepreneurs, the startups, apart from straight cash? And I'm going to start with Chris this time.
Yeah.
Mix it up a bit.
So my partner and I we kind of have two very distinct backgrounds. So mine on the medtech side, like I've started multiple companies. I've gone through exactly what, if you are building a medtech company, like what you're doing from the engineering side to the BD corporate strategy side. So just kind of helping on that end, whether it's connections to, hey, this is the right person that you might want to use for XYZ. So sorry if there's any regulatory consultants in the room, but I mean you could really get screwed on. People are in the business of making money as consultants, and so no fault to themselves, but you got to use people you trust, and obviously you have to be nimble as a startup. So that end, I think we also have a very good network of other VCs that we lean on. Like I think like everyone else here, and maybe I didn't answer this question. We're happy to lead a deal, but we're more than happy to co-invest with other VCs as well. So connections to other people just that we know kind of have an appetite for that specific type of company maybe you're starting. And my partner sold into hospitals for one of his companies that he started. So in that, like, he's very value added in terms of connections on selling in hospitals and more the kind of tech companies. But so we don't really have like a huge brand. Like we're just like two guys that like started companies and luckily made a little bit of money that we could start investing our own, and then other people want to invest alongside us. So like for us to get into deals, we have to be like very value added on the cap table for that other entrepreneur that gives us that reference. Like Sequoia is great, yeah, they have like huge check sizes, but they're not going to do anything for you. We'll say that.
Great answer, Chris. Thank you.
So yeah.
Mackenzie?
Yeah, so I'm just going to answer this from two perspectives. One is, so I'm an entrepreneur in residence at Rock Health, and that's a position, it's sort of like a fellowship for entrepreneurs building their next company. And so I will say that prior to this, I built a company actually in the consumer hardware space, and I raised venture funding for it. And one thing that I looked for when I was raising money that also attracted me to Rock Health then as I entered the healthcare space was a fund that could add more than, of course, just capital, that also had great experience and ideally a great legacy in the space. And so Extending that to what I'm doing now with Rock Health, one thing that I think makes Rock Health really special in the digital health category is that it has a great legacy of first being an accelerator about 10 years ago when digital health was very, very nascent. And they really saw an opportunity, and our founders decided to build something that would help grow the category. Now in 2018, we're hitting what we call the middle innings of the digital health category in general. We're seeing almost $6 billion flow into the category last year. We're seeing a lot of mega deals. And so that's a really great thing to have seen this space, from the very beginning and until, this moment, which is a really exciting moment in the category. So for me as an entrepreneur, I really appreciate that about Rock Health and hope that that's something other entrepreneurs appreciate as well.
So your incubator, what support does that provide?
Yeah, we used to be an accelerator, and now we're a venture fund. Yeah.
Okay, great. Good. Mike, I imagine you leverage all the university's capabilities. Is that where you
Yes, that's true, but actually that's where the work starts after that, actually, because I think what happens is you obviously want to leverage the maximum that you can from our university partners, so from a laboratory perspective. But then once these opportunities mature, especially as it gets into a company, I think some of the comments that Chris mentioned, whether it's regulatory or, really we touch any kind of operational component of a small early stage company across all those domains I described. So it keeps us, pretty busy ourselves. But from a mission perspective, we don't have an expectation because we do participate so early and really at the laboratory level. We have no expectation that this scientist should be a rock star entrepreneur from day one. And if that is our expectation, it's not fair to not provide the help. So we try to come in ourselves, or we augment through consultants or other partners that we have to provide the support that is necessary. And we even have our own lab space. We'll put them in that if we need to. It really just depends on the need of the company.
Thank you. Atul?
Sure, we're a little bit larger than most of the what you would consider investors. So if you look at our core team, we have about 14 professionals. So these are the scientists, engineers, in addition to the consultants and all that. So we actually play a very much a hands-on, roll up your sleeves kind of active role. In many cases, we are the entire management team. In other cases, we'll be actively supporting the management team. And I think it's across the board, right? Whether it's regulatory. I think we actually are pretty active from a business development point of view, very, very early in the process, because to us, the feedback that you get from potential partners is really important from a development point of view. We actually write grants. We've had over 25 grants across our technologies, which we've written, as well as playing all of the normal roles you would expect. That's required for.
You're very hands-on then, basically.
We are.
You have to be, because you're going very, very early, even
Yes.
at an idea stage.
Absolutely.
Good, thank you. I'm just going to, just to break up a little bit, I want to see if there's any questions, if there's anything burning that we can... Mark?
So the question I have is, you have different investment theses, but very early stage. So you really can't have an expectation on returns on investment for your exits and so forth. How are you all funded? What's the scope of the funding that you have? I saw some are investing their own money. And how many different projects do you have in your active portfolio at any given time?
It's a great question, Mark. Really good. So, directing anyone in particular, or just everybody?
Everybody.
Right, okay. Start at the far end, Mike.
Okay, make sure if I keep me honest, so I track. There was a couple questions in there. So we invest our own money. We have an endowment that is the kind of corpus of those funds. So a portion of that is dedicated to, say, the venture fund, and some is on the nonprofit side. In terms of like the ROI, the valuation, again, because we're a nonprofit, we have kind of a mission that we're trying to deliver. We do have a mission, a nonprofit mission. We need to have a favorable return so that we can keep this an evergreen opportunity. But my management team, our board, is very supportive of the mission, and so we will take early risk. But because we have these 3 financing programs, we feel like that's a very thoughtful way to de-risk it as we move forward. And so we're going to have some deals, hopefully, that are really big hits and make significant impact for patients in healthcare. And then we'll have some that aren't going to work. But we have, I think, the tolerance and understanding that that's going to be the way it is.
Mike, just to add my next question into this because it kind of leads it. So, if you talk a little about what you look for in terms of an exit as well, and because the expectation of that
And
capital.
sustainability.
Yeah. I think I'll speak for myself, it is a portfolio approach. So I think when you look at the portfolio, you'd want to be confident that you have some in there that are probably going to bring some big returns home. But if you have confidence that you have some good opportunities in that space, again, we're constantly balancing the mission, right? And so if if I was just a straight up VC, totally return driven, my thesis would be different. But so when a really interesting technology that can make an impact in healthcare, but might be like a single or a double, we still might do it. We are doing them actually. So, but then that gets to kind of partnering, where those are more, I would say, sometimes products or bolt-ons to existing partners' product portfolio, and so it's a win for them too, right? So it really, I think the portfolio approach helps make sure that you're going to have some big winners in there, but at the same time, as opposed to just a purely financial investor, we have to deliver on the mission, which takes us into deals that may not be as lucrative financially, but still may impact patients in a positive manner.
Thanks, Mike. Mackenzie?
Yeah, and to echo what Mike said about being mission-driven, that's something that is definitely the ethos at Rock Health. One thing we say is we're trying to make healthcare massively better for every human being, and so that's something that we look for both in the companies that we evaluate, and then also in the research that we do. And so one thing just to note as as I talk a little bit about the category is that we evaluate and we do research. And one thing that we do is we look at every digital health company in the US that has raised more than $2 million in venture funding. So maybe some of you have seen our annual funding in digital health reports or our quarterly funding in digital health reports, and we've been doing that since 2011. So as we are both a research organization and a seed stage fund, one thing that I certainly hear a lot of the organization is looking to maximize for impact based on evidence and research, which as I was joining Rock Health as an entrepreneur in residence, that was really interesting and really compelling. As far as auspicious signs of an early stage company, entrepreneurs will hear this a lot, looking at the team, looking at the founders and the background of the founders and the connection to what they're building, and that's always a really positive sign if you have an experienced founder or a very passionate founder, because it's all about learning really quickly when you're building a company. Another thing that is unique to early stage investing and being on the other side of it as an entrepreneur who's raising early stage funding is that a lot of times you're pre-revenue. And so what you're really doing is you're trying to convince people to bet on not just the category, but you're convincing people to bet on sort of your version of the future, and you can evidence that in a lot of ways. Sometimes you can have things like letters of intent from future customers, and other times you can have that qualitative feedback from other leaders in your space. And so that's another thing that you see a great deal in early stage investing. And then as far as any sort of exit opportunities or sustainability in the category, 2017 saw virtually 0 IPOs in the digital health category, and so a saying that I'm seeing a lot more now is that digital health M&A is the new IPO.
And so where does your capital come from, and what are the expectations on that capital in terms of return?
Yep, so our LPs are actually other funds. And these other funds can usually go beyond the seed stage, so that's also really, I think, exciting. And sorry, what was the other question?
Expectations on return on that capital.
Yeah, and expectations as far as...
When you say there are other funds, what do you mean by that? Sorry, they are larger funds investing in a smaller fund?
Mm-hmm. Yep, so larger funds, and then as far as expectation of return, so like I was saying, M&A is the new IPO, and so we're looking at, down the road, we're seeing a lot of larger healthcare companies really acquire sort of promising early stage digital health solutions.
Thank you, Mackenzie. Chris, keep it. We've got 20 minutes and I've got loads to ask, so just...
All right, really quick. So we're very unique, like I said earlier, because we do SPVs, so we don't maybe necessarily target a minimum ownership versus maybe some funds do. So we're flexible on that end. So as far as returns, obviously I would say because we're earlier stage, we very much look at comparables and we want to, make something that's still substantial. And as far as who our LPs are, we have a few high net worth individuals and family offices that back us. So that's kind of how we do our investments.
Perfect, Chris. Thank you.
So we actually have investors. We don't have LPs. We're set up as an LLC, and so we have a number of investors, mainly high net worth individuals from Houston. In terms of expectations of returns, we expect to make a return at some point. But our philosophy is that we have a robust portfolio and we look at new science because we are primarily in pharma currently, so it's a long time horizon. So we assume if it's strong science, we can play a very active role from a de-risking point of view, and it's a large enough portfolio. Eventually, we will get that return.
That's a good answer. So from our point of view, it's right now it's our own capital, and our viewpoint is more of an entrepreneurial viewpoint. If you build good companies and work with good people and have good science and not focus solely on the exit, you will actually get a really good exit. And that's so what we try to do is just build really good companies, and then the exits generally will just hopefully will come. And so that's our kind of philosophy on exits. I don't like discussing these things at the boards for hours and hours and like navel gazing at what's the exit going to look like. Let's just build a really good company, like a proper company, and the exits will come. And in the future, with our new seed fund, it's very much all high net worth angel investors who are investing into the fund because of the tax structure that we've set up in the UK, and we'll literally have to deploy all the capital every year as per the structure. So the expectations are that we will return capital in 5 to 8 years, but we have a different philosophy on the exit. So does that answer all your questions, Mark? Yeah.
Thanks very much.
Okay. So, in terms of valuations in the industry, it's always a difficult one for an entrepreneur to discuss that with an investor, and the investors kind of want to know quite early on what the expectations are, just to make sure that there's no mismatch moving forward. And early stage is incredibly high risk, so your evaluation needs to reflect that. And I know in the US you have this kind of 20% discount on the next round. In the UK, we just have this kind of straight vanilla valuation. It's low, and you go in. So, how do you approach the valuation discussion with early stage investors, which is sometimes incredibly difficult to evaluate? And so, what range would you say that you typically see, and what are the trends around valuations that you're seeing? It's more of a buyer's market, a seller's market, and I'm going to go with Atul first.
Sure, and like you said, it's an extremely difficult topic, and one which we frankly don't even get into, right? Because from our perspective, at the stage when we get involved, you really have no basis for doing evaluation, and that's why we stay away from things like immuno-oncology. So it's actually just a very straightforward discussion saying, this is what we're going to bring to the table, both in terms of cash and everything else we bring, and in exchange, this is the ownership stake that we expect. And so that's kind of an upfront discussion we have, and only after we feel like we're in the ballpark do we actually get into it.
And what do you typically see as a typical valuation in your sector?
I think again, Houston's much less, shall we say, competitive from an investing point of view than say Boston is. But I'd be shocked if we did anything where the valuation was north of $1 million.
North of $1 million.
Mm-hmm.
I'm going to invest with you.
Yeah.
Chris?
So, most our companies that we've invested in are definitely north of $1 million. So we see a few things. So one, a lot of the kind of coming out of YC, this whole safe notes and caps and whatnot is really the driving factor there. So for us, we're very flexible, like whether it's a convertible note or a safe in that sense, because it is difficult to have these valuation discussions. On maybe like a traditional Series A or even a little bit later, I hate seeing that. I want it to be a price round, just because I don't like being unaligned with the company in terms of almost rooting for that valuation to be lower so that my 20% discount on a convertible note is not as well thought of. So we'd like to see priced on a little bit later, but we understand on kind of maybe your first fundraising round that it's would be a note or a safe in that form.
So you typically like to see a convertible loan note. That's your
Yeah,
general?
I think it,
is it 20% discount? Is that what you typically do in general? Do you vary that?
It just kind of depends. So we've done so many different structures. Yeah, it's tough. But the biggest thing I want to see is a cap. That's the biggest thing I want to see versus a discount. So.
Okay. Mackenzie?
Yeah, to just quickly echo that, it varies wildly. But in seed and sometimes Series A investing, you commonly see convertible notes or safes. So there's a huge range.
Mike?
So transactionally, we have a model where, again, we source our technology from these affiliate partners. And so we have one model transactionally that works for all the universities where they own the IP, but there are a number of situations where they don't, say they're students and they're not under the IP policy or they've waived the IP policy. So we actually have an affiliate called HealthStart NJ who takes those on. In those cases, we typically use safes. In the case of our more traditional deals, we go right from basically a paid option to when we do the startup, it's a combination actually of equity and debt.
So can you give a couple of examples with numbers, you don't have to name the company, of the kind of deals that you've done?
Yeah, I think a little bit like the tools, these valuation and structures are pretty easy for us because it's just cookie cutter from our perspective. And at the stages of development where we participate, you could argue valuation forever. It's just very hard to actually come to a known valuation. So we have a cookie cutter model. We provide up to $500,000 in total capital, $250 cash, $250 in the form of debt. We get 25% of the company. That's the model. That means if you don't like it, then we're not going to be able to do a deal together. And sometimes there are companies that are more mature, say, than that perceived valuation would say warrant us getting a deal. And that's okay. If they're more mature than our model, then Series A investors will pick it up, and that's okay. We don't do it.
So that's typically around a $1 million valuation.
Around,
and then
yeah. And it's an interesting conversation because again, it's this blended. And when you're doing the math, I mean, you really have to first, pure valuation, just look at the cash, and so it's probably actually like $750 pre-money. But then they do get the benefit of the additional $250, which a lot of people don't want to. All they get stuck on the valuation number, right, on the equity side. But I'd say that you can't get access to $250,000 in debt, likely either, from a traditional source of capital. But the idea, the philosophy we try to bring to the entrepreneur, and we really believe this, is take the money in, blow through some valuation or milestones, and create more value. Build a very strong company. I think you mentioned it. Part of it is if you just build really solid companies, you're going to do well economically.
And one of the differences I've seen, or something about the US, is that these startup valuations are actually quite low, and in more or less in the ballpark with the rest of the world, let's say. But when you get to your Series A, they really ramped up the valuations, and I think that what I've seen, some of the valuations I've seen after the seed round, or even like a post-seed round, are kind of eye-watering. And then you're kind of blowing everybody else out of the water. You like 2 or 3 times the UK valuation at the next round or so. So I think it makes sense, once you get going, then, and one thing I always, an idea is actually not worth that much money. There's no value in it, really. It's an idea, we see lots of ideas, but actually executing an idea, that's where the real value is. And so we can get to that point, then it can really make a difference to the business. And I appreciate you sharing some of the numbers as well. Thank you. Again, I'm going to open it out to anyone else if they've got a question on that. Quite a hot topic. Otherwise, I'll move on to my next question.
So I heard Mackenzie and Mike did an answer in prior question, but given the additional risk of an early stage company, why do you invest in such early stage? So I didn't hear from Atul or from Chris or from Sunil. Why do you invest at such an early stage when there's less risk later?
That was a really good question. Yeah, it's a great question. So I'm going to think about my answer. I'm going to throw it out, Sharon's privilege.
I can answer that real quick on our end. So we don't invest in any deal with the exception of maybe like a couple of tech companies we've done, but anything on healthcare that we can provide value to. And so it tends to just be maybe on those earlier stage deals that we feel that we can actually contribute and kind of maybe help shape them a little bit versus maybe later stage where it's just capital. It's just like, we're not that big of a check size. It just doesn't really make sense for us on that end.
Got it.
So.
And I think in our case, it was just a function of where we are, right? I mean, the unmet need in places like Houston is really the really early stage science. And that's why we were created, but then we move along. So, I know that was going to be one of your questions, but if you look at some of our later companies, we've led a $16 million Series C for one of our companies and a $12 million Series B for another of our companies. It's structured a little bit differently. The money doesn't come from Fanon itself, but we lead it, and then we have other investors. But, it's almost, that's where we have to be, because that's where the science is.
Thanks, that's all. Mackenzie? Why early stage is the question.
Yeah, so again, optimizing for impact, generally early stage bets, it really comes back to our legacy as first an accelerator where we tried to grow the category with early stage companies, and now we try to continue that spirit of work by investing in early stage companies presently.
Mike, I think your answer is pretty obvious, so I'm going to do that. I think for us, we see a huge opportunity in therapeutics in particular. With the farmers downsizing over the last 10 years, and we've seen the brunt of that in the UK with Pfizer closing down Sandwich and GSK closing Harlow, these huge sites have just literally vanished overnight. The pharma companies almost turned into M&A engines, and they are literally looking for innovation, and they are now, if you look at deals like Padlock, which Atlas did, and a few others, they're starting to play proper money, and they're coming in much earlier if they like the science. If you can marry up, if you have those industry contacts and you're talking to the farmer, what are you looking for, what are you looking for, and you can find really great science early and then support that to a stage where it could even be, it doesn't have to be in the clinic anymore. In the old days, you have to be in phase 2 plus before farmer even looks at you. Now they're going preclinical, they want to have more input into the IP, and they're acquiring science much earlier and paying proper money for it. So in my case, it's I see it as an opportunity really, where I can see pharma acquiring, and we see great science in Cambridge, which is kind of underfunded at Cambridge UK, and we're being opportunistic in that sense, and we have this capability of in the life sciences space. So that's from our point of view. Is there any other questions before I move on to my next one? Which is a really good question, by the way. Another really good question. We've got 7 minutes left. I'm just trying to think if any of the panelists wanted me to bring anything.
You had a question in the front.
Oh, I didn't see that. Go on.
Yeah, you're coming in early stage. So are you looking in more of a B2B type of environment rather than a B2C because the track's longer? I mean, are you focusing, are you interested in B2C type of investments, going to consumer?
I think it's more for the digital health and the IT and people, I would have thought.
Agnostic, like it could go either way. Like I've seen one company go one way and pivoted. So,
but as an angel investor or early coming in, are you because your exit to be M&A, to be purchased by a larger firm, or is it to actually go IPO or go push it further out?
I think most of our stuff is probably M&A. But I mean, not to say that IPO wouldn't. It's just where the industry seems to be going. Just seems all tuck-in acquisitions and whatnot.
Kind of leads into this question. So, what in terms of if anyone in the audience is interested in approaching anyone here about something, what kind of information would you like to see? What's the right level of information for you to make a decision swiftly? So we'll start at Mike at the other end, keep it and move to me.
I mean, we typically start with kind of an executive summary. It includes a lot, really, the scientific data to support the base technology, and then we help them evolve it to a little bit more of a commercial pitch with typical kind of SWOT analysis, market sizing. We have this standard checklist, if you will, of what I think most VCs would look for, but we say we don't have an expectation that they're going to know all that information. We just ask all those traditional questions, fill in what they can, and then we help them, source the other information. Again, it sounds like a cop-out answer, but we take them as they are and then try to find good opportunities, and we'll do external research ourselves.
Yeah, so in the digital health category, again, generally it's less biotech or medical devices, any sort of, IP or science play, and more betting on a category in the market. And so it's mostly doing your homework as far as the market that you're approaching. B2B and B2C scale very differently. So it's just having a really thoughtful plan about how you're going to grow a really successful business, because the data says it will likely end up in some sort of M&A deal as an exit.
So the question was just like, what are we expecting from a company like when they're pitching us, or?
Yeah, say someone's going to approach you from here. Let's get practical.
Yeah, so-
what are you expecting, or what would you?
Yeah, send, decks is always good, and then if you have some type of warm introduction, I'm more than likely to look at it versus just, you could figure out my email pretty easily, but if if it comes from, a tool or whoever, I'm just more likely to look at it, whether it's, there's so many resources, whether it's LinkedIn or someone to stalk someone and kind of make something, I went to the same college as you, or whatever it is.
That's a great point, Chris, because if you can find someone, we're all fairly well networked now with social media and everything else. It's much easier for us to evaluate something we know has come from someone we trust, and I think that's really important point for anyone looking to raise early stage capital. So thanks for that.
So in our case, it again depends on the stage. The ones that are really early stage, in many cases, people who approach us have probably never seen a business plan in their life, let alone written one. And so it's kind of more like Mike said, come talk about the science, and we'll figure out together whether it's something that's worth getting engaged in. In some cases, it's a little bit later stage than we would expect to see a more traditional pitch, if you will. But typically we'd like to start out with a one-pager.
Yeah, what we want to see is just the science, really, and not market size or anything like that. Again, we were very early, and it's literally, our CSO will evaluate it and say, this is something that we're interested in, if it fits into what we want to do, and then we can come and ask for more information. So it's really, even a couple of paragraphs on why the science is just really great from our point of view. In terms of control, if you make an investment, maybe you can make a quick comment on what kind of level of control you would want to see on the board, and it's always a difficult one for an entrepreneur to let go in a way, somewhat, but what level of control would you typically like would you have on the board? We'll start with Mike and work this way.
So we always get a board seat, and we actually have quite a bit of control. I would say there's covenants in the closing, and really it's for the benefit, like we said, we're willing to take early risk on scientists and entrepreneurs that don't have any experience. So one way to mitigate that risk is to, control is maybe not the right word, but to have these covenants in there so that if they can't go to the casino and spend the $250K that we put in there. But there's a lot of requirements there. They need our kind of permission to move forward. But then what we see happens is over time, as they mature as managers and entrepreneurs, we waive some of those where it makes sense. And it's great. We have a company right now that's doing phenomenal. And it was founded by 2 PhD students. And they are learning fantastically. And they're becoming really solid entrepreneurs. And as that occurs, we waive more, we restructure, and it seems to work out.
So significant control, which becomes less. Very quickly, moving on, we've got one more last question, and we're going to wrap up. Mackenzie, if you can just say,
Yeah, in my experience, board seats for early stage digital health deals and at the seed level are relatively uncommon. So that's not an expectation.
Not an expectation for us either.
Yeah, we're kind of in control at the very early stages, and then as it evolves, we'll step back, including fewer board seats. But up front, we are kind of almost running the company.
Yeah. So we don't have any control issues at all. We work on a lot of trust in that sense, and we'll take a board seat sometimes if required. Depends on who else is around the table. So the last question is, we missed out on a really big opportunity quite recently. We reviewed a business plan. It was right in our sweet spot, probably kind of got missed between and fell between the gaps and everything else. And it was a seed stage investment in an area which was of interest. And we didn't make the investment. We were all really busy, and it just didn't quite happen. And it then, and my brother, who's my business partner, was championing it solidly. So he was really unhappy when he read about 3 months later, that he got bought for over $1 billion. And obviously, ripples were. I felt the full wrath, and everyone in the company did. So we can't get all of them, and we don't always get it right. But obviously, we missed out on something very big. Have you ever missed out on anything very big, and can you name the company? Anyone?
I have one example that just happened a couple like a month ago. So Clorette just got bought by Boston Scientific, and I knew a bunch of people that started a company and had an opportunity to invest, and I didn't. And I'm not like that upset, but I'm a little upset. So anyway, that was one that just happened recently.
Yeah. Anyone else? On that note, well, thank everyone for their time today, and thank you for attending our panel session. Thank you very much.
Thank you.
I obviously want to thank the panelists for all their time and preparation they've done for this. Thank you very much.